A 401k is a good way for families to save money. Many people start investing with their company's 401k plan because, well, it's easy. And sometimes a company adds money to your account too. This is easier than opening a different account and picking investments by yourself. But just putting money into a 401k for many years doesn't mean you'll have enough for a comfy retirement. Surprisingly, most people have only a little over $88,000 in their 401k, which isn't enough. The AARP says you might need about $1.5 million to retire comfortably. So why aren't people saving more for their retirement? There's more to getting ready for retirement than just signing up for a 401k, and many people don't know the best ways to save and invest for their future. Now, before we start, this is Ivan here from The Vanilla Investor, a former investment analyst and with over 100K invested in the markets. My goal is to bring you simple finance at your fingertips. The first mistake that people make is not using your company's 401k match. Then we have holding too much of your company's stock. Third is not increasing your contributions over time. Fourth, cashing out when you change jobs. Then, ignoring the drawbacks of a 401k. Sixth is not tracking how your investments are performing. And last, cashing out your 401k for a big purchase. So without further ado, let's dive right in. Mistake number 1, not putting in as much money as your company offers to match. One of the best parts of a 401k plan is the employer match. This is like extra money your company adds to your retirement account when you put in some of your own money. For example, if your company matches up to 5% of your salary, you should try to put in at least 5% to get the full match. If you don't, you're missing out on free money. This matching can really help grow your retirement savings, but there's a catch called vesting. Now, this means you might not fully own the company's contributions right away. For example, you might own 0% of the company's match in your first year, 50% after 2 years, 75% after 3 years, and 100% after 4 years. If you leave the job after 1 year, you won't get the company's matched money. So if you're thinking about changing jobs, check your vesting schedule. Sometimes it might be worth staying a bit longer to get the full value of the matched contributions. Mistake number 2, buying too much company stock. Sometimes you can buy your company stock at a lower price, which might seem like a great deal, but it's risky to depend too much on one company's stock. Experts recommend most investors keep their money in broad investments like index funds or ETFs, and only have about 20% of their savings in individual stocks. You can spread this 20% across one or few different stocks, but it's important not to invest too much in just one stock. Putting all your money in one basket is risky. Now, many employees trust their company and invest a lot in its stock. Unfortunately, if the company has problems or goes out of business, you might lose your job and a lot of your retirement money. To keep your money safe, spread your investments out and don't count too much on one company's stock. Mistake number 3, not increasing how much you save in your 401k as you earn more. Usually, the amount you put in your 401k is a part of your salary. So if you save 5% of what you earn in your 401k, that amount goes up if you get a raise. But if you want to save more and maybe stop working sooner, you should try to add more over time. For example, if you make $40,000 each year and save 5%, you're putting $2,000 into your 401k every year. If you get a 5% raise, your salary goes up to $42,000 and your 5% savings goes up to $2,100. Although you're making $2,000 more, your 401k savings only go up by $100. Since the money you use to live doesn't go up as soon as you get a raise, you could start putting 10% of your yearly salary into your 401k, which would be $4,200. Even if you feel like spending your raise right now, adding your money to your 401k will help you a lot in the future. Real quick, if you're enjoying this and you want to learn more about investing and personal finance, then I would appreciate it if you could join my free newsletter in the link below. I send out a weekly newsletter about personal finance and investing tips like this one straight into your inbox. So if that sounds good to you, check it out below. With that said, mistake number 4 is taking money out of your 401k when you change jobs. Now, if you get a new job, don't take out your 401k money. This could mean a 10% early penalty fee, especially if you're under 59 and a half years old. Plus, you'll owe a lot in taxes. Sometimes you can leave your money in your old job's 401k plan, but not always. If you have to move your money, think about putting it into an IRA or into your new job's 401k plan if they have one. A direct rollover puts the money right into the new account, so you won't spend it by mistake. Mistake number 5, not knowing the limits of a 401k. While 401k plans are helpful, they have their downsides, and it's important to know them and look at other choices. One big problem is the small range of investments you can pick from, usually only a dozen or so. These choices might be okay, but the fees can be higher than an IRA or an individual retirement account. With an IRA, you can choose from a lot more investments, which might cost less. Even a small fee of 1 or 2% can really lower how much you save by the time you retire. Also, IRAs let you invest in single stocks if that's what you want. Another thing to think about is taxes. Putting money in a Roth IRA can be good because you don't pay taxes on it when you take it out in retirement, unlike with a 401k where you do. Deciding if it's better to pay taxes now or later depends on how much money you think you'll make in retirement. If you think you'll be in a higher tax bracket then, relying only on a 401k could mean a big tax bill. Mistake number 6. Not paying attention to how your investments are doing. When you first chose how to invest your money in your 401k, you picked different risk levels. But if you haven't checked on these investments since then, it's important to start now. It's crucial to keep track of how your investments are doing compared to the overall market. And every year counts because your savings can grow a lot through compound interest. For example, if your investments average a 10% return over your career, you'll have more money at retirement than if they average only 6%. The overall market usually averages about 10% each year, so that's a good goal to aim for. But remember, returns can change depending on how the market is doing. To check if your returns are good, compare your funds to similar ones. If you have a small cap fund, you could compare it to the S&P Small Cap 600 Index. If you have a target date fund, compare it to a similar one from a company like Vanguard. And if your fund isn't doing well, there's no need to keep your money there. If you have many years before you retire, you can take more risks with your investments. And if you find that your 401k doesn't have good options, think about putting extra money into an IRA or even a regular brokerage account after you get all the money your employer will match. Mistake number 7. Taking money out of your 401k for big purchases. This is one of the worst financial choices you can make. Using your 401k money to buy something expensive like a new car or fancy items might seem easier than finding other ways to pay for it, but it can hurt your money in the long run. If you withdraw money before you're old enough to retire, you'll have to pay big penalties and taxes. The biggest problem is losing the chance for your money to grow over time. And when you keep your money in your 401k, it can grow a lot, like a snowball getting bigger as it rolls down a hill. Taking out money early stops this growth, so you'll have less for the future. Only take money out as a last choice after you've tried everything else. To avoid needing to use your 401k money, try to save enough in an emergency fund to pay for 3 to 6 months of living cost. And this can help handle unexpected expenses without hurting your retirement savings. Investing in a 401k is easy for everyone, and starting one is a good beginning. If you understand a bit about it, your money can grow over time. But if you want more options than just a 401k, think about a Roth IRA. Many people talk about how good a Roth IRA is with a 401k. Watch this video to learn how you can save enough with a Roth IRA and be a tax-free millionaire by investing just $12 every day.